In the first video, we covered what a cash-secured put is. In the second video, we covered how to pick the right strike price. But now we get to the part that matters most in real trading. What happens when the trade goes wrong? You sold a cash-secured put. You collected a premium. The setup looked reasonable. The stock was trading above your strike, and then the stock dropped. Now your put is in the money. The option is worth more than you sold it for. An assignment is suddenly a real possibility. This is the moment where many beginners panic. But if you have a framework, you do not need to panic. You have three choices: close early, roll down and out, or take the assignment. This video is for educational purposes only. It reflects personal experience and research, and it is not financial advice. Options trading involves risk of loss, so always do your own research before making any investment decision. The key question is simple. The stock dropped. Your put is now in the money. What do you do now? This is the moment every cash-secured put seller eventually faces. The stock is below your strike. The put you sold has increased in value, and if the option expires in the money, you may be assigned 100 shares at the strike price. That is the situation. The problem is assignment risk, and the answer is not to react emotionally. The answer is to decide using a preset framework, because when you are already underwater, it is very difficult to think clearly. You start asking emotional questions. Should I close? Should I roll? Should I wait? Did I make a mistake? But the better time to make that decision is before the trade ever goes wrong. So in this video, I'll walk through the three choices available to you when each one applies and how I decide between them. The goal is not to avoid every losing trade. That is impossible. The goal is to stop one losing trade from turning into a panic trade. When a cash-secured put moves against you, there are only three main responses. Choice 1. Close early. This means you buy back the put at the current higher price, realize the loss, and move on. The premium you collected originally cushions the exit, but you are still accepting that the trade did not work. Choice 2. Roll down and out. This means you buy back the losing put and sell a new put with a later expiration, usually at a lower strike. The goal is to give the stock more time, reduce your strike, and collect new premium to offset part of the loss. Choice 3. Take the assignment. This means you allow the put to expire in the money and accept 100 shares at your strike price. Your real cost basis becomes the strike price minus the premium collected. From there, you can start selling covered calls, which is the beginning of the wheel strategy. Each choice is valid under the right conditions. Close early when your thesis has changed. Roll when your thesis is still intact, but the stock needs more time. Take the assignment when you still believe in the stock long-term and you are comfortable owning the shares. The mistake is not choosing one of these paths. The mistake is choosing randomly, emotionally, or too late. Option 1 is to close early. This is the most direct response. You sold a put, the stock dropped. The put increased in value, so you buy it back to close the position. You take the loss, protect the remaining capital, and move on. But here is the important distinction. Close early when the thesis has changed, not simply because the price moved. There is a big difference between a temporary price move and a broken investment case. A temporary price move could be broad market weakness, short-term volatility, or a sector-wide pullback. That does not necessarily mean the company itself is broken. A broken thesis is different. That could be a major management issue, a fraud concern, a structural earnings miss, a regulatory problem, or a sector disruption that changes the long-term outlook of the business. In that case, closing early is not a weakness. It is discipline. Let's use a simple example. You sold a put for $1.50. That means you collected $150 in premium. The stock drops, and now the same put is worth $3. To close the position, you buy it back for $300. You received $150 earlier, and now you pay $300 to exit. Your net loss is $150, plus any commissions or fees. That loss is not pleasant, but it is controlled. And sometimes controlling the loss is the best decision. Because the worst thing you can do is keep defending a trade after the reason for entering it no longer exists. Option 2 is to roll down and out. Rolling means you close the current losing put and open a new put further out in time. Usually, the new put has a later expiration and sometimes a lower strike. The goal is simple: extend time, lower the strike, and use the new premium to offset most of the cost of closing the original position. Let's walk through the example on screen. The original put was at the $92 strike and expires in 2 weeks. The stock has moved against you, and that put is now worth $4.50. If you originally sold it for $1.50, buying it back at $4.50 creates a $3 loss, or $300 per contract. Now, instead of simply closing and walking away, you sell a new put. This new put has a $90 strike and expires in 45 days. You collect $2.80 in premium, or $280 per contract. So the original close costs you $300. The new put brings in $280. Your net result is a small debit of around $20, but in exchange, you lowered your strike from $92 to $90 and you gave the stock more time to recover. That is the logic of rolling. But rolling only makes sense under one condition. Your thesis on the stock must still be intact. If the business is still strong, the reason for the drop is temporary and the new premium meaningfully offsets the cost. Rolling can be a useful management tool. But rolling can also become dangerous, because if you keep rolling a broken stock, you are not managing risk anymore. You are delaying a loss. That's why I use a rule: maximum 2 rolls. After 2 rolls, I either take the assignment or close the position. I do not roll forever. Rolling should buy time for a valid thesis. It should not be used to avoid admitting that the trade was wrong. Option 3 is to take the assignment. This means you allow the put to expire in the money and accept 100 shares at the strike price. For many beginners, an assignment feels like failure, but an assignment is not a failure if you still believe in the stock and size the trade correctly. In fact, an assignment is part of the cash-secured put strategy. When you sell a put, you are agreeing to buy 100 shares at the strike price if the stock falls below that level. So if you sold a $92 put and collected $1.50 premium, your real cost basis is not $92. Your real cost basis is $92 minus $1.50. That equals 90.50 cents per share. So if you are assigned, you own 100 shares at an effective cost basis of 90.50 cents. From there, the wheel begins. You own the shares. You can now sell a covered call above your cost basis. For example, you might sell a $95 covered call and collect $120. If the call expires worthless, you keep the premium and sell another covered call. If the stock rises above 95s, your shares may be called away at 95s. In that case, you earn premium plus share appreciation. But again, this only works if you still believe in the stock. Do not take an assignment on a company you no longer want to own. Do not take an assignment just because you are trying to avoid realizing a loss. Take the assignment only when ownership was already an acceptable outcome when you entered the trade. That is why strike selection matters so much. So how do I choose between closing, rolling, or taking the assignment? I use 3 questions in order. Question 1. Has my thesis on this stock changed? If the answer is yes, I close early. That is the cleanest decision. If the reason I wanted to own the stock no longer exists, I do not roll it and I do not take assignment. I close and redeploy the capital. If the answer is no, I move to question 2. Do I have the capital to take on an assignment without over-concentrating my portfolio? This is important. Even if I like the stock, the assignment means I now own 100 shares. If that position becomes too large relative to the rest of my portfolio, the risk may not be acceptable. So if taking the assignment would over-concentrate me, I may close or restructure instead. If I have the capital and the position size is acceptable, I move to question 3. Can the stock recover within a sensible time frame. If the stock only needs to recover 5% or 10% over the next few months, I may be comfortable rolling or taking assignment. But if the stock needs to recover 40% or 50% just to get back to my cost basis, the math becomes much harder. At that point, closing and redeploying capital may be the better decision. So the decision framework is, if the thesis changed, close. If the thesis is intact but the stock needs time, consider rolling. If the thesis is intact, capital is available, and I would still hold the stock, take assignment. The framework protects you from emotional decision-making. Now, let's look at a real trade I managed badly, and the problem was not the stock. The problem was one simple checklist step I missed. I sold a cash-secured put on a large-cap consumer brand. The strike was $88. The premium was $190. The expiration was 35 days out. At the time, the stock was trading around $95. I thought the setup looked reasonable. The strike was below support, the premium was attractive, and I was comfortable with the company. But I mischecked the earnings date. Earnings came out on day 22 of the position. The company missed expectations, and the stock dropped from $95 to $82 overnight. That is a 14% gap down. I was assigned at $88 while the stock was trading at $82. That created an unrealized loss of roughly $600 before accounting for the premium collected. Now, this trade did not end in disaster. I held the shares. The stock recovered to around $91 over the next 3 months. I sold covered calls throughout the recovery. Eventually, the position ended net positive. But here is the important point. It tied up $8,800 of capital for around 4 months in a position I never should have been in. The issue was avoidable. The fix was simple. Check the earnings calendar before entering the trade. Every time. This is why process matters more than confidence. You can like the stock. You can choose a reasonable strike. You can collect a good premium. But if you accidentally hold through earnings, you introduce binary risk that can overwhelm the entire setup. That one checklist step would have prevented the entire situation. Here is the quick reference for managing a cash-secured put when it goes wrong. Close early when the thesis has changed. How? Buy to close and accept the net loss. The premium you collected cushions the exit, but the priority is protecting capital. Roll down and out when the thesis is intact, but the stock needs more time. How? Buy to close the current put and sell a lower strike with a later expiration. The rule, maximum 2 rolls. If the position is still underwater after 2 rolls, stop extending the problem. Take the assignment when you still believe in the stock and would hold it through recovery. How? Let the put expire, accept the shares, and sell covered calls above your cost basis. The rule, only take an assignment if you would genuinely hold the stock. The key is to decide your response before entering the trade. Before every trade, ask, what will I do if the stock drops below my strike? What will I do if the thesis breaks? What will I do if I get assigned? If you cannot answer those questions before the trade, you are not ready to enter. So let's recap. When a cash-secured put goes wrong, you have 3 choices. Close early, roll down and out, or take the assignment. Close when the thesis breaks, not simply when the price moves. Roll when the thesis is intact, but the stock needs more time. Take assignment when you still believe in the stock and are comfortable owning the shares. And most importantly, always check the earnings calendar before entering any position. In the next episode, we'll cover the wheel strategy, how cash-secured puts lead into covered calls, and how the full income cycle works once you own the shares. Subscribe so you do not miss it.